Every time you buy at the top of a strong move, someone is selling to you. And more often than not, that someone has been waiting for you to show up. In this video, you'll learn a pullback strategy built to put you on the other side of that transaction, entering where risk is small, instead of chasing where it merely feels safe. We'll break down the 3 levels where pullbacks tend to die, how to stack them into high confluence zones, and 3 ways to confirm your entry using real price action and indicators. It's sharp, it's strategic, and it works when you have the discipline to follow the method. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. One quick note before we start. This lesson is part of our technical analysis course, and it was built for beginners, traders who are still learning how to read a chart. If you follow our smart money concepts and ICT content, you'll notice that some of the levels we mark here, trend lines, support, and resistance, often sit right next to areas you already know as supply and demand zones, order blocks, or fair value gaps. That's no coincidence. Different schools are often reading the same footprints with different tools. So, if you're an SMC or ICT trader, watch with that lens in mind. And if you're a beginner, master these foundations first. Later on, I'll recreate this same video with the same examples through the smart money lens. Then you'll see exactly why so many traders today go beyond trend lines and support and resistance, into market structure, order flow, and imbalance. First, let's cover the foundation. What exactly is a pullback? It's simply a correction within an ongoing trend, a temporary move against the main direction. So why is it so important to understand? Let me give you a scenario. Imagine the market is in an uptrend, and you're looking to enter a buy position. Now, if you've traded for any length of time, you know it's rare for a trend to move straight up without interruptions. Most trends actually look like this, a series of higher highs followed by pullbacks. So if you enter right when price is making a higher high, there's a real chance a pullback or even a full reversal could hit you. Instead of taking that risk, it's safer to wait for the pullback before entering. That way, you're buying the same trend at a better price with lower risk. Here's the uncomfortable part. The entry at the higher high feels safe because the move is already proving you right. That's recency bias doing your analysis for you. The entry on the pullback feels wrong because you're buying while price is falling. In trading, the entry that feels safest and the entry that is safest are rarely the same one. Now, I know what you're thinking. How can you tell whether the pullback will end here or keep falling? Well, based on my research, there are 3 common levels where pullbacks usually stop. The first one is support and resistance. Let me show you an example. On the left, we saw price reject this level several times, marking it as a resistance zone. Then, price broke above that resistance and made a pullback. And notice exactly where it stopped. The previous resistance had turned into support. After that, price climbed higher and pulled back again. And where did it stop this time? Again, at the same support level, the old resistance. This concept also works in downtrends, just mirrored. But why does an old ceiling become a floor? Because of the traders trapped above it. The ones who sold at that resistance watched the breakout go against them, and loss aversion keeps them holding, hoping for one chance to exit at break even. When price returns, their buying to close, plus new buyers who missed the first move, is what stops the pullback. The level holds because real people need it to hold. Moving on, the next level where the market tends to pull back is the trend line. In this chart, we spotted a downtrend, so we can draw a trend line above since price has rejected it multiple times. Now, notice how price pulled back to the trend line and dropped, then pulled back again and dropped again. That's a pullback into a trend line. Understand that a trend line has no power of its own. It works because thousands of traders draw the same line and act at the same price, a shared reference point. By the third touch, that line has an audience, sellers defending it and buyers waiting to see if it breaks. You're not trading geometry, you're trading agreement. Another level where price often pulls back is the moving average. Here, we identified an uptrend, so we applied the 50-period moving average as our key level. Now, remember, in this case, we're using the 50-period because that's what the market has reacted to recently. But markets can also respond to other periods, like the 20, the 100, or even the 200. So you adjust based on what the market is actually reacting to, not on a favorite number. As you can see, price pulled back to the moving average and moved higher, then pulled back again and moved higher again. That's how a pullback to a moving average looks in action. And the reason it works is similar. The moving average is a reference point everyone can see. Traders who miss the start of the move anchor to it as their second chance, and their orders concentrate around it. When enough participants treat the same line as fair price, their reactions are what make it real. Now, building on that idea, there are also situations where multiple technical levels come together on the same chart. In this example, we've applied the 50-period moving average, and price pulls back. But take a closer look. There's also a support level intersecting that zone. This creates what's known as a high confluence area. Usually, when price approaches an area of confluence, the chances of a reversal are higher. And now you know why. It's no longer one crowd watching one level. It's several groups of traders, each with their own reason, all prepared to act at the same price. But remember, you can't just enter a trade blindly because price touched a level. It can still break through and keep going. The touch is an invitation, not a signal. That's why you need confirmation before entering a position. Confirmation is what separates you from the trader who buys the touch on hope. It forces the market to show its hand first. And one of the techniques we can use for that is candlestick patterns. Let me show you an example. Here's a current downtrend, with price forming lower highs and lower lows. We've applied the 50-period moving average as our key level, along with a resistance line intersecting it, creating a strong confluence zone. Now, as price pulls back into that area, you want to see if there's any sign of rejection. And in this case, we got a candlestick signal, a bearish engulfing pattern, where the second candle's body completely engulfs the first. Read the story inside those two candles. Buyers initially pushed price up, forming a medium-sized green candle. For a moment, they were winning. But then sellers took control, driving price back down, even below the previous candle's open. That's the exact moment one side gave up and the other took over. Strong selling pressure at this level. And if you want stronger confirmation, you can wait for the next candle to form, which in this case was another large red candle. That makes it a solid opportunity for a short position. Let's look at another chart. On the left, we identified a resistance zone, where price had been rejected multiple times. Then price broke above that resistance and pulled back. To confirm that price would reject the level and continue higher, we looked for signs of rejection. What we saw was a rejection candle in the form of a hammer, where the bottom wick extends noticeably. That wick tells you sellers tried to push price down, even breaking the support briefly, and got absorbed. Buyers stepped in and drove price straight back up, and every seller trapped inside that wick becomes fuel for the move higher. Their forced exits add buying pressure at this key level. Now, to further confirm that price would continue upwards, the next candle was a large green one. That makes it a solid opportunity for a long entry. To summarize, the key is simply identifying candlestick patterns that show rejection at your level. Moving on. The next confirmation technique is called the break of a trend line. Here's how it works. In this chart, we're in a downtrend, with a trend line drawn as our key level. As price pulls back into that trend line, we want to confirm whether it will reject the level and keep moving down. We can do that by drawing a smaller trend line within the pullback. Once price breaks below that smaller trend line, that's your signal to enter a sell position. Let's walk through another example. Here's an uptrend with a trend line drawn underneath it. We also identified a resistance level nearby, creating a strong confluence zone. Now, as price pulls back into the confluence zone, you draw a smaller trend line above it. To confirm the signal, you wait for price to break above that smaller trend line. Once it does, that's your cue to enter a buy position. Notice what that smaller trend line really represents. The pullback is a mini trend of its own, and the traders riding it are trading against the larger flow. When their line breaks, their stops start going off, and their forced exits become the push behind your entry. You're not predicting the turn. You're joining it while the other side gets carried out. But keep in mind, if you find a setup where the trendline breakout doesn't fit, don't force it. Instead, use another confirmation method. In this case, we saw a bullish engulfing pattern, so we used candlestick confirmation instead. That's why it's important to master multiple confirmation techniques, so you're not dependent on just one. If the market doesn't support one method, you switch to another. The goal is loyalty to the process, not to a tool. Now, moving on, another powerful confirmation tool you can use is the RSI indicator. Here's how the strategy works on this example chart with the RSI applied. Looking to the right, we saw price reject a level multiple times, marking it as resistance. Then, price broke above that resistance and made a pullback. Now, you're looking to see whether price will actually reject this level and move higher. Instead of guessing, you wait for the RSI to cross above the middle line. When it does, that gives you a solid long entry. Let's go over another example. Here, we have a downtrend with the RSI indicator applied. We noticed price rejecting the upper area multiple times, which allows us to draw a trend line above. Then, we identified a clear support level, creating a confluence zone. Now, as price moves back up to that area, we want to confirm if it will reject the level and continue downward. To do that, we wait for the RSI to cross below the middle line. That gives us a good short entry. And here's the real value of that middle line. It takes the decision out of your emotions. Your urge will be to anticipate the cross, to enter early so you don't miss the move. That urge is FOMO, wearing an indicator's clothes. The cross either happens or it doesn't. Evidence first, entry second. In conclusion, trading pullbacks isn't about catching every move. It's about waiting for the right one. And notice the single thread running through everything you've seen today. The old resistance holds because trapped sellers need out. The trend line holds because a crowd agrees on it. The engulfing and the hammer are one side surrendering to the other. At every level, there are two sides of the trade, and this strategy exists to put you, deliberately, on the disciplined one. The strategy is simple. The tools are clear. But most traders still lose. Why? Because they enter too early. They skip confirmation. They trust the setup, but not the process. If you want real consistency, it starts with patience and ends with discipline. So whenever you see a pullback forming, remember, the power isn't in the setup, it's in how you choose to act on it. And that choice starts with restraint. Many traders feel the urge to be constantly active, clicking, reacting, and forcing trades, simply to feel productive. But successful trading doesn't reward activity. It rewards precision and discipline. Listen to how a professional trader puts it. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.